going to start off with a talk from Robinson West. Robinson West is the founder and chairman, I believe, now of PFC Inc., which is, I believe, stands for Petroleum Finance Company Corporation. It is up there with IHS Sarah as the leading energy consulting firm in the country, and since Robin is here, he is representing the number one energy consulting company in the country. He will give us an overview on some of these issues relating to market reactions. He has some slides he's going to show. It's going to be followed by Mark Campanelli from Carbon Tracker in London, and Mark is going to talk about how capital markets are changing, and he has some slides I think that are on your seats as well, and discuss that. Then we have Robert Johnston. Robert Johnston is an energy consultant. He's a Canadian also by birth, and is going to also talk about, I guess, maybe the trading markets and the effect of some of these new developments. And our moderator, we're very fortunate to have Bill Platt, who is the energy...
Bill Loveless from Platt.
Bill Loveless from Platt Energy, who is going to be the moderator. So with that, why don't we start with Robin West.
Okay, thank you.
And here's your clicker right there.
There's my clicker, okay. I'm sorry I wasn't at the previous session because I think some of the things I'll touch on were touched on as well there. What I want to talk about is a little bit how this extraordinary surge happened in North America. It's something which nobody predicted. None of the smart guys predicted, and whether you consider me a smart guy or not, anyway, we missed it, as did, frankly, all the other, quote, experts. But something really quite extraordinary has happened, and it's really very powerful. We call this trends in the energy landscape. What you can see here is surging production from tight oil and the shales in the United States, and in situ and oil sands mining in Canada. The deep water, where I'd had experience in the past, was kind of the good news. Other than that, the US was seen as mature and declining, and Canada was seen as flat. So we have this extraordinary surge. On the question on imports, a lot of times people talk about American energy independence. We consider that in terms of oil a nonsense. You cannot be independent. You can have improved energy security. We defined energy security as reliable supply at reasonable cost in an environmentally sustainable manner. And what's happening now is that we clearly have reliable supply. You can see here, this is total imports. This is if you back out Canada, because North America and Canada are more or less unified. This is a percentage of all US energy. I was quoted in one of David Ignatius's columns saying that I thought this was the energy equivalent of the Berlin Wall coming down. And that something which had really traumatized the country in the 70s has now been dramatically reversed. I would also point out that Francis Fukuyama wrote a book after the Berlin Wall coming down, said it was the end of history, that liberal economies and liberal democracy and free market economies are going to prevail, and it hasn't kind of quite worked out like that. And so I would be somewhat hesitant in saying that, you know, all is well and all is predictable, and I think that's a little bit what this conference is to talk about today. One of the things that's quite extraordinary, if you take the four big plays here for oil, the Bakken, Eagle Ford, Niobrara, and the Permian, you can see here that production has surged up to the point where in a very short period of time, really starting in 2007, here we are in 2013, beginning to 2013, effectively we've created a new province on the scale of Libya. And so this is really an extraordinary event. But I think one of the things that's important to understand, that I feel very strongly about, how did this happen? And this happened because it was a private sector response to market forces. Natural gas prices, natural gas, not oil prices, were very high in 2005, 6, 7 in there. And basically, it was the independents who saw a commercial opportunity. The gas prices were so high that any gas well was profitable. And so they went out and exploited gas wells that nobody else had before, and that's how you got into the shale. And it was George Mitchell at Mitchell Energy, and it was the independents who did this. But again, I think markets worked extraordinarily efficiently, that in the sense you had high prices, you had a market response, technological innovation, and what's happened is that gas production surged, gas prices collapsed, gas productivity rocketed. The number of wells has actually gone down, although production is up and prices are down. And the industry said, well, because gas prices are now so low, because we created this huge bulge or surge in production, let's shift to oil, which is what they did, and you have this extraordinary surge. So the next thing is that the American system, really going back to the period of the 70s, that you had historically imports coming into the East Coast, the Gulf Coast, and down here in California. And what's happened now is that you have surge in production from Canada and the mid-continent United States, and everything's reversed. In the old days, as I say, the crude was coming in, processed on the coast, and then imported internally. Now you have crude being produced internally, and it's moving to markets outside. This is Cushing, Oklahoma here. One economist described it as the Roach Motel. You can get in, but you can't get out. So you have this tremendous backup, but one of the things that's happening now, again, is market forces are again working because you don't have efficient ways to move the crude. And so you have different qualities of crude coming in different places. You have Gulf Coast refineries that were responding to previous production patterns, which was basically we were importing heavy crudes because they were cheap. And if you could process them, the industry invested billions of dollars in these deep conversion capacity refineries. But now you have a situation where you have all this light crude coming down, and the fact is that these refineries can't process them. One of the things, again, you have these huge distortions that are taking place, and you have some crudes up here. The light sweet crudes up here are now trading at a discount of $50, as much as $50 a barrel off Brent, which is the globally quoted price of oil. And you have deep discounts in parts of the Bakken, and literally 100 miles away, one area of the Bakken from another, you can have a $10 or $15 discount on a barrel of oil. One of the theories of the oil business has always been it's a transparent market and it's a fungible commodity. Well, it's not exactly that. And that's what we're learning. And we have, an infrastructure system that represented investment of tens of billions of dollars, which now has to be really reversed. And you'll have a situation, for example, a lot of people don't realize the impact that this market distortions can have. For example, if the crude comes down here, if you can't move it in pipelines to the East Coast, and you can't get Jones Act exemptions for ships, for American tankers to be able to move it from here to here, that means that the crude that people on the East Coast have to use to run in their refineries come from the North Sea. And so that the consumers here are basically buying gasoline priced off Brent. In the mid-continent, you have very low oil prices, but gasoline prices don't reflect that difference. Why? It's because, again, it's not a big, efficient market. And who's making the money here? It ain't the consumer. The consumer isn't benefiting. The people who are benefiting are the regional refiners who can buy crude at a very deep discount and then sell it to, into a broader market. The other people, trust Warren Buffett. he's figured out how to make money on this, because one of the things is that you have a pipeline system here that is, as I say, it's ill-suited, it's very inefficient. You've got to build new pipelines. But Warren Buffett, when he bought the Burlington Northern Railroad, they're making a killing. I mean, the coal business is quite depressed now, but instead they've moved to shipping oil by rail. And if you go to Philadelphia, you will see these huge trains coming in. And so, at any rate, you have the situation taking place that market forces are or the structure of the industry is having difficulty responding to market forces. And there are huge discrepancies and disparities. And I think if you get into policy discussions this afternoon, I think my only counsel is it was market forces created this, the situation of surging production in an extraordinarily short period of time. And it's distortions in markets that are causing some of these discounts. And then if you're looking at policy options, be terribly careful about price and watch price. Price will drive behavior. That's how this whole thing happened, this North American transformation. And be careful that there aren't unintended consequences of one's actions. And I used to be an assistant secretary of Interior. I argued strongly in favor of full cost water pricing. You can see how much influence I had. There was no full cost water pricing, much as I argued for it. Likewise, if you want to factor in carbon, that's fine. But just be careful, because sometimes the politicians don't get it right. Now, one of the things also to point out is that what happened in North America, the government had virtually nothing to do with it. This is all the shale wells. We've modeled this, my firm. We have a model that's about 400 million data points. And what you can see here is where the activity is, and here are the public lands. Almost none of this has happened on public lands to date. Now, let me finish on this slide. I mean, one of the questions is this extraordinary transformation going to take place elsewhere in the world? I'm reminded of the lobsterman in Maine. You ask him, been a lobsterman all your life? Not yet. Think the fog will clear? Always does. The fact of the matter is that, for example, China, the estimates that the resource estimate for hydrocarbons from shale is larger than the United States. But you can see here that we have drilled, actually we've drilled over 30,000 wells in the United States. Whereas in places like Australia and China and in all of Europe, if you followed in Poland, there was great excitement about shale and everything like that. You need at least 100 wells to prove up a play, at least 100 wells. And you can see that in China, they haven't even drilled 100 wells. Now, one of the things that happened also in the United States, going back, I keep coming back to market forces because that's what permitted this to happen, was what we had in the United States. You had access to land, you had a resource base, you had access to those resources, you had a gas market, you had capital markets which permitted independent companies, which were innovative, to raise the money or sell the gas forward to finance it. You had a gas gathering and transmission system, and you had a service sector. And in most countries of the world, you may have a resource base, but you have almost none of the other factors. So that what's happened in the United States is really this extraordinary, almost unique transformation. And I think that, again, going back to 1973, that the United States, if you saw the holiday edition of The Economist, they had a walk through hell, and they had smug bankers with their pockets full of money for greed. They had Silvio Berlusconi chasing a buxom devil for lust. And for gluttony, they had Uncle Sam gobbling oil. That's just not accurate anymore. And I think that whereas energy consumption had been a real challenge to the moral legitimacy of the United States, really from 75. And in 1975, you had a situation where our production was starting to decline, but our consumption continued to go up. We really were glutton. but we've now changed all of this. But I think it's going to be very difficult for the rest of the world to do that anytime soon. So I'll stop there.
Mark Campanelli is also the founder of Carbon Tracker Initiative. Maybe you can tell us a little bit more about what that's about. Yeah. But he's also a founder and innovator in social investment, started several social investment asset management agencies, and was on the World Business Council for Sustainable Development's social investment in capital markets program. So
thanks for that. Hopefully you will have found on your seats or outside, picked up a handout. It came from London overnight. Just a few slides which I want to talk to. Investors are great. If you can understand what investors are doing in the energy sector, it helps us understand where we're going on climate. The idea behind the Carbon Tracker Initiative was to look more carefully at what investors were doing. And we had a question a very simple question that we wanted to answer, which is that if we took the world's largest publicly traded oil, coal, and gas companies, we took the reserves, the proven reserves, converted it to CO2 equivalent, what are the markets telling us we're going to in terms of degrees warming? And so we did the maths. We produced a report called the Carbon Bubble Report. And if you look at the reserves, what the markets appear to be telling us, once you factor it in, state reserves are being sold, along with privately owned companies' reserves are being sold, is the markets seem to suggest we're going to 6 degrees of warming. So if we were to take the reserves. And so in your handout, what we produced at Carbon Tracker, and it's just been reproduced by the IEA, World Energy Outlook, that came out just before Christmas, and you'll see a series of concentric circles, is of the proven reserves that we have, in terms of the budget, I'm afraid the numbers haven't come out on the printout so well. There's 2,795 gigatons of CO2 are embedded in the proven coal, oil, and gas reserves that we know of. And the listed companies own around 745 gigatons of CO2 equivalent that are in the reserves. But the remaining budget that we've got to stated to degrees warming is 565 gigatons of CO2. So, in a sense, what we've done is we've gone way beyond the budget. So now, what Carbon Tracker does is we're looking at the numbers of new coal, oil, and gas IPOs, and we produced a map which you've just got a part of that. And our map, you can download it from our website. We mapped where the reserves are listed in terms of the world's exchanges. It looks like this. You can see a version of it in the handout. That the two main centers are obviously the States for fossil fuel financing and the United Kingdom. These are the two, and also Russia. But these are the two major global centers for financing oil, coal, and gas. Last year, for the first 6 months of the year, 70% of all the new IPOs were for mining, coal, oil, and gas. Before Facebook last year, the largest IPO was a tar sands company that listed in Hong Kong. And the simple message we have is that the financial markets are becoming more carbon intense, not less. With all the initiatives we have on climate for investors, they're becoming more carbon intense, not less. And this presents a challenge to us in terms of thinking if the markets are going to develop all these reserves, and we have to assume that we're going way beyond the targets we're setting ourselves of in terms of a balance. So the question I think I was asked is what percentage of the reserves that are being developed, the ones that investors are coming to, are made up of unconventionals, and that really makes up the rest of the handout. Now, just for ease, and these will come out in black and white. There is a graph showing the percentage of unconventionals in oil major portfolios. It's a line graph. And you'll see that over the next 20, 30 years, the estimates that the bankers produce. Now, if you work in Wall Street, and I know some of the people here have done, is they're fantastic sources of data about what companies do, the who, the what, the where. We just picked up a couple of these, Alliance Bernstein and Citigroup. And just the latest research that they've produced, you can start to see the percentages and the projected millions of barrels of oil equivalent a day that are going to be coming from unconventionals, deep water oil, deep water gas, tight gas, shale oil, and so on. And clearly the trajectory is, what the investors are financing today is a development and expansion of unconventionals. And it will form quite a significant part of most oil companies' portfolios, or the major ones, the integrated oils, within the next 20, 30 years, are significant. So the questions we have from our analysis is, if these reserves take us, that are already in the public markets, take us way beyond where we want to be in terms of climate policy, why are investors continue to add new reserves every day? Our maths tell us that we can't afford to burn or develop somewhere between 70-80% of what is already publicly traded, that underpins the valuation of these companies. Why are we replacing new reserves every day? Why are investors continuing to pour investors' money, citizens' money into developing new reserves? And we don't know the answer to that question. One of the things that we do know is that there is no regulatory body that is following this. There's no one within the banking system whose duty it is to look at the loan portfolio going out of all the major banks to the sector. No one is looking at the embedded, as a regulator, CO2 that sits in the big coal, the big oil, the big gas companies which are publicly traded. We can hypothesize what would be the impact on valuations of a typical portfolio. So our estimate, somewhere between 10 and 20% of an average investor's portfolio is going to be allocated to fossil fuels. If we want to stay to 2 degrees, and we're saying that we don't want to develop 50, 60, 70% of that, clearly there's going to be a valuation hit on the average investor's portfolio. And at the moment, from the regulator's perspective, no one is collecting the data or looking at that. And that's where Carbon Tracker fits in, is to start to get a better understanding of that and better understand risks. And so we've been set up just specifically to look at a very narrow set of questions around financial stability, market risk, what the market's already financed, who's measuring those risks, and whether we should have a policy response to it.
We have next Robert Johnston from the Eurasia Group. Robert?
Thank you very much, Bill, and thanks to the Carnegie Endowment folks for inviting me. We greatly appreciate the chance to speak to this group today, and certainly a very timely topic with the new administration, or the administration being its second term. So at Eurasia Group, we are yet another consulting firm. We do focus on politics, particularly the nexus between politics and markets. And my job is to look at that with respect to the commodity markets, particularly oil and gas. So I'll speak to this North American unconventional story, which is becoming a global story in many ways, primarily from the perspective of that intersection between politics and markets. I just want to briefly touch on 5 things, adding to what Robin said. Looking at the changes in the U.S. market specifically, then turning to how the IOCs, the international oil companies, are adapting, I think, to some of the points of the previous panelists, then turning to the geopolitical implications of these changes, then brief comments on price and the oil sands, and I'll give you the highlights, don't worry. I won't try to do it all. So just on the U.S. side, I think it was interesting to hear Deborah Gordon's comments about the refining sector, and other people look at the U.S. refining sector. And I do agree that, of course, refining is a very cyclical business, and for some refiners, we are back in another golden age, as we were maybe 8 to 10 years ago. I think the key thing to think about as we consider how the downstream side is reacting to these changes in the feedstock, crude both simultaneously getting heavier and lighter in terms of the U.S. refiners, is, who are the advantaged refiners? It's all about flexibility and location. And I think that the largest refiners that have flexibility in the way they configure their operations, the kind of crudes they can run, and are on a location where they can get refined products out to the global markets, i.e. on the water, are doing quite well, and will probably continue to do quite well. The problem for us as the analytical community is that the specifics of how those refiners deal with these challenges are very proprietary, right? That is the essence of their competitive advantage. So when asked, okay, well, how will this particular refinery, under what circumstances will it run light or heavy? Under what circumstances will it turn its coker unit off that allows it to run these heavier barrels? Under what circumstances will it sign an agreement for rail to get rail from the Bakken? Don't know. Most of them won't talk about it. So that is a challenge to consider on the market side. But I think my overall view there is that refiners are flexible, and the best ones can actually adapt and actually prosper in these conditions. if they can continue to export refined products to the higher growth markets in Latin America and Europe, and if they can continue to get access to these advantaged crudes. I think from a political point of view, this whole idea around exports of all types of energy from the U.S. is going to be a big issue for the second term here. We already have a healthy debate on LNG exports. We're seeing it heat up on crude exports. We got the Jones Act issues that Robin mentioned. There's debates over coal exports, Warren Buffett's other big play, coal exports to the Asian market or the European market, even petrochemical exports. So I would just put that out there as a point to consider. And this crude and gas unconventional story fits right into that for sure. On the international oil company side, I think that there was an earlier comment about how the challenges to access conventional oil resources globally, especially in developing markets, pushed the international oil companies, the US and European companies, back into their home markets and to pursue these unconventional opportunities. I think that's true in large extent, that having a crisis in Venezuela or Iraq or Russia with everything that happened in UCOS and some of those big political risk stories did make the home markets of the US and Canada in particular more attractive. But obviously without the geology, we wouldn't be here talking about this. A couple points to add to that, though. It's not just these North American, European companies that have come back. It's also the national oil companies from China, from Malaysia, from India, from Russia, Thailand, that are all piling into the same place here in North America as well. So that's an interesting story to consider. And also in terms of political risk, I think that as these companies shift their mix, they're obviously not out of developing markets by any means, but as they shift the mix more back towards the developed market unconventional plays, we feel like they're trading one form of political risk for another, right? You're going from concerns about nationalization and political violence and sort of legislative unpredictability to more concerns around social license to operate. All the things that people in the room are talking about with carbon, with water, with flaring, all those things are the challenge to the industry at this point. On the geopolitical side, one point I would throw out there is that I think the next thing to consider here in 2013 as we look at the markets is we've looked at the North American oil story and the sort of Middle East oil story as being two kind of separate things over the last couple of years. The Bakken has been really interesting, the Eagle Ford has been interesting, but there's been this big discount of these U.S. crudes versus what's the Brent and more global types of crude oil. I think the story of the next couple of years is going to be the reconnection of those two stories, particularly as that crude import number drops in the U.S. The question I think that the market hasn't really asked yet is, well, where are all those barrels that used to come to the U.S. going to go, right? Well, they're going to go to Asia, into that higher growth market, and I think that suggests a more stable price look out there while allowing for all the usual shocks and risks that we could see in that scenario. I do think that's a very important development that's worthy of discussion. In the short term, it's not a huge impact because we have the Iran sanctions, which has knocked out 1.5 million barrels a day or so of Iranian supply. And you could argue there's always something like that disrupts supply. But I think over time, we're going to see a lot of light sweet crudes, especially from Africa, that will increasingly find their way to the Asian market. On price, I share everyone else's caveats about talking about price, but I think the point I would make briefly is, unconventionals in the U.S. and Canada are just one driver in the global oil market, and we should be careful not to suggest that there's too much here that's going to drive prices. Because essentially what we're talking about with North American oils now is it's not really different. It's a differential story. So yes, there's a discount for WTI and for the the Canadian oil sands barrels and so forth, but directionally it's still following the global oil prices, and that will continue. Right, the big shocks in the global market will impact the direction of prices in the U.S., even if those differentials are still fairly wide. Another key thing to consider on price, I would certainly watch Iraq as a big wild card here as well. If Iraq hits its potential, and Robin's firm does great work on this, if they hit their potential, then that plus North America is going to increase OPEC spare capacity, reduce the call on OPEC, and lead to a more stable oil price environment, maybe. It's a scenario to consider for sure. And then lastly, yes, I am indeed a Canadian. I'm not an Albertan, but I certainly spend my share of time out there and work closely with those companies. We didn't hear a lot on the Canadian oil sands in the previous presentation. And in terms of the volume growth, they're doing just under 2 million barrels a day in the oil sands now. And that'll probably, almost double over the next 10 years. Some of the more higher cost marginal projects won't come online if these oil prices, stabilize somewhat and we can't resolve these infrastructure bottlenecks. But I think it's worth considering in the context of Keystone XL and these other debates in Washington, well, what do the Canadians really want? right? What is their focus? And I think increasing the focus is on market access, right? Pushing oil down into an U.S. market that's saturated or becoming saturated and is starting to back out imports and has a weak demand profile and has strong fuel efficiency programs. The Canadians feel boxed in, right? The U.S. demand is slowing. There's infrastructure challenges, and yes, there's a potential market in Asia, but trying to get those pipelines through British Columbia is very, very difficult. So now there's a fairly lively debate in Canada about going east, not just to these refiners in the Maritimes and the east coast of the U.S., but potentially all the way east through the Suez or around the Cape to India, where they can actually process some of these heavier barrels. So that shows you how dire things are from a Canadian point of view. I do think that there's going to be, back to this point about a pipeline by pipeline fight. I think that's very much how the Canadians are looking at it in a different kind of way. That they do feel boxed in. The Albertans in particular need a high oil price to fund their budget. They're tipping back into deficit. It's a big political story up there that's very much impacted what's been happening in the U.S. So a few additional topics for us to consider here in the discussion.
Thank you. Excuse me. Thank you very much, Robert. And we've had a good start with this panel, and I think it's a good intermediary panel between the discussion Deborah and all had initially on the very makings of unconventional oil and what will be discussed this afternoon in terms of policy. But I think understanding the market fundamentals, what drives investment, is very, very important to our own broader understanding of this topic. And one issue that came up, Robin did a nice job of describing some of the macro features of oil development and unconventional oil development, as well as the infrastructure. We saw as well some of the challenges faced by still another market that's very undeveloped, and that's the carbon market, and some of the challenges, environmental challenges, that sort of lie in the wings right now in many regards to determine where this oil market goes. And then, of course, we have with Robert the broader perspective here, sort of a global view of these different oil markets, including his boxed-in native Canada. But I'd like to get back, Robin, at this question of investment. You mentioned that this shale boom was driven initially by the natural gas companies, George Mitchell, hydraulic shale, horizontal drilling, hydraulic fracturing, and all of this. And it's turned into more of an oil boom now. But what specifically is driving the decisions on investments by companies, and which are the companies that are likely, or what types of companies, and even which companies are likely to be the leaders in this going forward?
Well, it's an interesting question because it's important to understand the process of production from shale is different than traditional exploration and production, and that it's much more a manufacturing process. In the previous panel, it's pointed out that there's a very high decline rate, and so these wells go like that, as opposed to more traditional wells, which kind of go like that, and then they have a much slower decline rate. There are many more wells, there's lower amounts of production, and higher decline rates in production. But there's an enormous proliferation of the resource. And this is a model which fits independent oil companies. Independent oil companies drive their business for production growth, and they know how to manage it. Whereas the major oil companies, traditionally, they go for big projects. I mean, the area that I have a lot of background is offshore oil. That's a business that's perfect for them. It's 10 years to build one of these platforms. It costs millions, hundreds of millions to drill wells, billions to build platforms. It's a huge, long-lived, capital-intensive kind of project. Whereas onshore, again, it's much more a manufacturing process. That's why you have 30,000 wells having been drilled. And the fact is that ExxonMobil has come into the United States with the acquisition of XTO, but they've had real difficulty with it because it's a completely different model. I mean, they are peerless at building huge projects. We're not talking about building huge projects. We're talking about thousands and thousands of little projects. And so, I mean, one of the things, my business was started on the basis that capital was flowing out of North America and out of Europe into the rest of the world. Now, the United States is the #1 destination for capital in the world. But it's not clear who's going to make money here.
You don't think it'll be the majors will play an increasingly larger role here?
They would like to figure out how to do it. Chevron has, Exxon has a big investment. Chevron is kind of moving cautiously. Shell, they have positions here, but it's part of a global portfolio. And again, they manage their business for returns. Independent oil companies for production growth. And so it's really a different model and a different set of players.
Do you see more foreign investment coming in here? We've seen China, for example.
Well, there's a huge amount of foreign investment. And particularly the foreigners that came in. My favorite deal was a deal that Anadarko did with Mitsui. It was a 90-10 deal. And I believe that Anadarko makes money at 79 cents per MCF. And Mitsui makes money at $7.90 per MCF. Nobody thinks gas is going anywhere near $7.90 anytime soon.
So what is that telling you?
It caveat emptor is what it tells me. But this is a different kind of business, and it's managed differently. The technology is different. I mean, one of the things that I tried to make on that chart that's clear, this extraordinary surge in production. Well, you know, if you make big discoveries in the Gulf of Mexico, and in 2005, if you'd made the discovery, or 2007, or whenever it was on that chart, you have to understand that you would have no production yet from a new platform. It takes that long. So this is something that's happened so quickly, but it's lots of little things rather than one or two big things.
Yeah, go ahead, Rob.
Yeah, just a couple things to add to that. I think that looking at these independent companies, I mean, it's interesting. A lot of them have actually divested their international assets, and recognizing that the largest independent companies are having a hard time trying to focus on this complexity of the North American play at the same time as doing deep water in Brazil or in the Caspian. So we've seen a lot of big independent companies really refocus on North America and really reduce the amount of global exposure that they have. And then on the integrated side, the super majors, I mean, the one additional tool they have in their toolkit is the downstream. The fact that if you look at the big oil sands players and some of the new IOC money that's going to the Bakken and the Eagle Ford, they have the ability to hedge some of that volatility around crude oil prices, raw oil prices, by downstream returns as well, especially if they can get those downstream products, the diesel and gasoline, out into the global market. So it's a couple other ideas on where the money's going to be made.
If there's one other point I'd like to make, and that is in that chart where I tried to show the four big oil plays, it stacks up to Libya. Well, or the chart on the level of imports. We disagree with some places that are more aggressive and believe production will be higher, slower. We're all going to be wrong, I guarantee you, by 2020, because things are happening so quickly. I mean, for example, there is a play in California called the Monterey Play. And some people, I'm not a geologist, but there's some people who think this could be a huge play. And hundreds and hundreds of thousands of barrels a day production brought in very quickly. There are levels of innovation, again, driven by price. I keep coming back to this. That's going to drive a lot of things, but it's going to happen a lot faster and much less predictably, frankly, than these big projects that were sort of stacked up by the industry.
Mark Campanelli from Carbon Tracker. You were talking before about the concerns over the carbon impact of all of this and the uncertainty over where the investment is coming from. We've heard a little bit, in some sense, about these investments. What does this tell you, or what concerns does this raise with you in terms of how the impacts this may have on the environment?
Let's be clear about this. What we're seeing in the capital markets in each of these sectors is it's a grab for territory. It's a grab for reserves. And the reason why people are going to the Arctic and going to rather unusual places is because the easy to find stuff has already been taken. And when you look at the valuation of publicly traded big oil and coal companies, it's supported by the reserves. And if you've got reserves going out 20, 30, 40 years, that supports the stock price. Now, if you're not replacing those reserves and you're selling it off, obviously your future as a business is uncertain. So the reason why these unusual oils and the capital's going in is to keep the reserves replacement ratio up. Now, what that means is there's all this curious, the heavy oils, unusual oils, the expensive stuff to develop, that's suddenly coming in and forming such a significant part of the portfolio of the integrated oil companies. Now, the question we have to ask ourselves is, if all this oil and certainly the coal and the gas, if this is all that's already been financed, this has already been built into the markets, if it's all burnt, as the markets seem to suggest, over the next 40 years, then without doubt, we're going way beyond the projections the scientists have given us to stay below 2 degrees. Now, we can do that. I think we have to be honest with ourselves. If we're going that direction, we have to plan for a planet that's way beyond 2 degrees. If we want to do that, we just say yes.
But where's the investment opportunity, though? I mean, what's the stimulus to drive anything like that?
The question for the investors is that they're missing the wood for the trees. They're looking at each individual company. They're looking at the investment strategy for each individual company and for the reserves replacement. They're not looking at its entirety and saying, is the entirety of the investment going into these new oil, is that going in the right direction? And from our point of view, clearly it's not. But if we look at the alternatives, all of a sudden, if we heard earlier on about getting rid of subsidies for fossil fuel, it suddenly makes the alternatives, the renewables, look more attractive. On the margin, I think it's in the chart that we've got out. Citigroup produced a report that said the tar sands and the heavy oils only really become economically viable at $90. And the price is at 40, 30, 40, 50. I don't know the exact price now. So we don't know actually whether people are making money today developing these heavy oils, and this is something do we know the answer to these?
And they may in fact not be
questions?
developing them. I think that the steam-assisted gravity drainage in situ projects, are probably $60, $70. But you're right that these higher cost mining projects are $90 to $100, and I mean they're just not being green lighted at this point. I think the only thing I would add to what you're saying is that it is still talking about reserves replacement, right? It's not reserves accumulation. And I think that the additional piece of context to your outlook is, what was the IEA's forecast for world oil consumption, say 7 or 8 years ago versus now, right? I mean, we're seeing that it's starting to slow down, even China, and we can debate whether that's sort of a short-term downturn or a big structural change there. I wish I knew. But I think the point is, if we see that demand growth start to slow, and it's going to keep going, but it's not going to grow at the rate that we expected. I'm just talking about crude, not about gas and coal. Coal scares the hell out of me. I agree with you on that. The point then is that you're pushing the marginal price down of oil, right? And that those fields in Canada, the most carbon-intensive ones, may not get developed. So that there is an interplay between that, and that's something I think that we need to consider as well.
Well, Robin, from your perspective, to what extent do these carbon considerations drive the investment decisions?
Oh, I think they're very important. I peered over Mark's shoulder that he has his total carbon, but a big part of that is coal. Sure. And with all due respect, don't blame the oil industry.
Sure.
That's kind of what I was going to do.
The other thing is that this breakthrough in North American, I know we're supposed to talk about oil, but North American natural gas, the United States is now approaching 1992 carbon emissions from energy level. We're at 1992. The consumer is ahead of the game, and we're ahead of target. Germany, for example, which has mandated offshore wind, which has photovoltaics in a Nordic country mystify me. You have very, very high cost. It's leading to the deindustrialization of Germany. I mean, I don't think the temperatures going up 5 degrees is a good idea. I don't think deindustrialization and driving jobs away from a country is a good idea either. And I would respectfully submit that the Euro-Green approach really ignored market fundamentals and created huge distortions. And that what's happened in North America in terms of climate is a happy accident. I mean, let's not kid ourselves here. But it is that. I mean, it's worked pretty well. But I think one of the other points that should be made, one is I think you're absolutely right that a number of these projects, whether it's deep water or heavy oil or whatever it is a function of price, and they'll be triggered. But one of the things that's important to recognize is once these projects basically get past final investment decision, once they're sanctioned, they go ahead. And even if price goes down, they will continue to produce. And some of the Canadian projects, are marginal right now. And one of the things which, again, I tried to make the point, affects that margin, affects the price, are the logistics and the distortions in the market.
What is the appetite for the Canadian oil overseas? We know there's a tremendous amount of interest in it, but when you look at business opportunity or investment decisions, those sorts of considerations, how strong is that vis-a-vis what the options for simply sending the oil into the U.S. via the Keystone XL?
I mean, I have to say that I've talked to my Canadian friends and Albertan friends about this, and I think they've made a huge miscalculation on Asia in the sense that there's not a single refinery in China that can easily process diluted bitumen at this point. The Chinese are building one basically to take Venezuelan crude. Right now, if you were the Chinese and you were building a refinery, presumably you'd want more than one feedstock to go into that plant. So yes, there will be an opportunity for dilbit, but that's going to be maybe 150,000 barrels a day. So you can't get around the fact that the best refineries in the world for processing this stuff are on the Gulf Coast, right? Yeah, maybe down the road there will be greater demand in Asia. There's certainly demand there for light and medium type barrels. So I think the big card the Canadians haven't played yet, and there's politics around this and market risk, is will they decide instead to send synthetic crude oil, which is more of a medium type barrel, into the Asian market where there's going to be a lot more capacity to run it. I think in general the Asian NOCs that have gone into the oil sands are looking as a long-term play. That they want the technology, they want to accumulate reserves, but their time frame for when that oil actually shows up in Asia may be much longer than what the Canadians realize.
Let me add one thing. The Asian national oil companies, particularly the Chinese, what they want is secure supply. The rates of return on investment is much less important to them. But there was a decision about the Chinese national offshore oil companies' acquisition of Nexen. And the Canadians said that they would not be enthusiastic about further investment. Buying companies could invest in projects. So they're going slowly. The other thing is that the big project that was going to move this oil to the Pacific coast in Canada is called the Gateway Project. And the Gateway Project, my analysts tell me, is got big problems and probably won't happen. And it's because the Indian nations won't let it go through.
Yeah, agreed.
Mark, do you feel as though you're swimming upstream a bit when you hear what's going on in the industry, the oil industry, and the opportunity and the demand, simply the demand for oil around the world? I mean, do you feel you're a bit up, and also the projections too that we've seen what's happening with carbon emissions in the U.S. and they're expected to remain relatively low going forward. Do you see this as a particularly difficult economic argument to make in the U.S. right now?
Yeah, emissions are emissions, whether it's in the US or China or anywhere else. And what we have to look at is the collective emissions annually from all nation states, of which the US is just one part of it. And then we have to break it down into where those emissions are coming from. The trajectory on emissions globally is still going in the wrong direction. And the numbers of years out that we've got to really to get it under control is diminishing. When I look at new, very sort of substantial capital investments into developing reserves which can never be combusted, I wonder whether the capital markets are really aligned with climate policy, and the answer is clearly that they're not. How many, whenever I try and have a discussion with climate specialists about finance, they put me in front of an economist. An economist and financiers are different groups of people. And so when you speak to climate policy people, they start to talk to me about finance. They talk about carbon taxes, and actually what I'm thinking about is bankability, investability of very substantial oil, coal, and gas developments. And economists actually, apart from the few that work in the banks and the fund managers I've worked with, are just a small number. The real decisions are made by the asset managers, the investment managers, and as far as I can see, very few of those are having any active discussion about climate policy. They're not getting the data, they're not seeing the whole picture. And that really is the gap that needs to be closed. I'm guessing in the audience, there's probably maybe a half a dozen bankers here.
Can we ask for hands?
This is DC.
Any bankers?
No, but
Don't worry.
But what it does tell us is that most people that are interested in climate policy are not bankers.
Yeah.
That's
a good point.
And that is a problem that we have because we've got to get those two communities talking to each other to understand really when you've got the fund managers and the bankers allocating, we saw a figure, 27 billion. These are big numbers, and if it's going to be wasted or stranded because these reserves will never ultimately be developed, then probably we've got a misalignment of the capital markets.
That's a good point. We'll go to Robin, and then we'll open it up for discussion from the audience. Robin?
The 2 points I'd like to make. One is that, with all due respect, your chart doesn't mention national oil companies. And 75% of the hydrocarbons are owned by national oil companies, not by the international oil industry. The second point is that, frankly, that the United States, by a happy accident, and Europe, by policy, are trying to manage carbon. It's the OECD countries that are addressing this, and they are making investments, and they're trying to drive, and at some cost themselves. But the developing world refuses to. For what the politicians would view as perfectly logical reasons. And I do think it's a fair question as to what extent is the OECD supposed to bear the cost for the whole world. And obviously there are politicians in this town who have strong views on that subject.
Go ahead.
Yeah, I do. I mean, let's go back to our numbers. Our numbers assuming that states own somewhere between 70 and 90% of the known reserves, coal, oil, and gas. And the publicly traded ones own 10 to 20%. Even if we just took those publicly traded companies and their reserves are sold at the same rate as state, we've already bust the budget in terms of what's already publicly traded. So we did factor that in. We only took in proven reserves, not possible reserves or known reserves that you're developing. So we've actually taken a very conservative picture, and it could be considerably worse if we took reserves which are known but have yet to be booked. On the question of OECD countries, if you took the top publicly traded Chinese coal companies in particular, the largest investors are American fund managers. So when we have to think about capital, like Coal India, those types of businesses, they're financed by European and US pension funds and asset managers. But they raise their capital by coming to New York, and they raise their capital by coming to London, and who's ultimately financing the Indonesian coal, the Botswanan coal, the South African coal, the Chinese. These are being banked and financed by American banks.
By Mr. Rothschild.
And by Mr. Rothschild. And so the key here is the capital and the people who make the decisions and the people who regulate the capital markets. And they, in my view, in our view, they've missed this one in the same way that the regulators missed Lehman. They knew about it, but no one was watching it until it was too late.
Good point. Let's take questions from the audience. Please identify yourself and just wait a second for the microphone as well. Right there, please. That puts you at a competitive disadvantage here because the mic is way back there. It's coming.
Yeah, that's what I mean. Yeah,
Exactly.
that's what I mean.
Hi, Nina Gardner. I teach corporate social responsibility at AU, but I also do investor relations for Enel, which is an Italian electric utility. And from that viewpoint, I'm actually seeing a real shift, and I want to come to save Mark here, who's been under a barrage. I do see a shift from the social responsible investment community that is finally percolating to the institutional investors, and they're starting to ask those kind of questions. So the more information, and this goes back to transparency, that we have about carbon, but also water, and the more education that we can provide the analysts, the more they're going to start asking questions. And there's this big push also from the campuses around the country and around the world, thanks to Bill McKibben, who is doing the sort of divest from fossil fuels alternative, that the companies, I would hope, are going to start thinking seriously about their financial viability in the future. So the question, I think we need the panel from this morning to help educate the experts who are doing the math, because at the end of the day, as you say, it's a question of price. So
But the price
also-
of carbon.
the price of, well, we have to put a price on
That's
carbon.
right. Without the price of carbon, it isn't going to happen.
There will, in my view, there will be no price.
And a price
there
on
will be
water.
No price on carbon.
And a
You're
price
saying
on
there will
water.
be no
No,
price.
I don't believe there will be a price
Yeah.
on carbon.
Yeah.
Because it's unimplementable politically, and the business interests will be such that it will come against it. In the United Kingdom, we had a price on We had fuel accelerated fuel tax, and we had protests in the street. And it didn't quite bring down a government, but it certainly made them think, and they took it off. I think the challenge to put in a carbon price will come. The acceptance of it will come too late, regrettably. In my view, well, I think we have to use different strategies to get to where we want to be.
Well, I think you have to add, in addition to price, you have to talk about risk. I mean, I just disagree with the assertion that the oil sands investors aren't focused on this. I assure you they are. And I think that, Statoil, BP, Total, Shell have all had shareholder resolutions basically on whether or not to divest from these plays. Now, they didn't get a lot of votes, but they had to take it seriously. And I think Alberta does have a carbon price, and where that price is going to be 10 years from now is something these investors do factor in. And further, I think without that kind of investor pressure, which granted was driven by NGOs and others to focus on this, I don't think you would have as much progress in Alberta as you've had on things like lowering steam oil ratios, trying to reduce GH intensity. Of course, they have a hell of a long way to go, but they're better now than they were 5 years ago, and there's a number of things that go into that. But I think, at least with the oil sands piece, I think there's been the financiers and traders and analysts have paid a lot of attention to this.
Let's go way in the back, the very last row.
Hello, I'm Con Nugent from the Heinz Center. Just as a public service, I'd like to make known the availability of 12 cubic feet in my bookshelf space, now occupied by peak oil literature. And
They ignored market forces.
And indeed they did. And I look forward very much to the policy discussion to come, in which the environmental groups are going to have to come up with a different rationale than the rationale of scarcity, which I think is really an important point of departure. But Mark, I have to ask you, would you please go into a little more detail as to why you think there will be no price setting on carbon as a political and financial investment reality?
Mark?
Gosh. It's based on my interpretation and understanding of the politics of it. I think it's a magic bullet. It would be great, it will be accepted and worked, but it has to have some kind of global application. We've seen the collapse of the clean development mechanism. I sit as a director of a fund investing in emission reduction projects in different parts of the world, and the collapse in the price of CERs has destroyed the value of the portfolio of emission reduction projects, to the point of, I put a value of 0 on these projects. I think having a fix on a carbon price as being the magic bullet that gets us to where we want to be requires a degree of political acceptance and agreement that isn't there yet and is nowhere close to being seen. But if you look at other areas, I think there's more hope. Now, for example, if you've got reserves on your balance sheet, if you've got reserves as a company for coal or oil, and you've told investors that these reserves are going to be developed, and we know as a whole, all the reserves that are in the public market can't be developed, if they are, they're going to go way north of where we want them to be, then the accountants are going to have to start to qualify the accounts. And when you produce an IPO, and the directors of the company are signing off on a multi-billion-pound capital raise for development, for reserves that are out 20, 30 years that may never get developed, how the accountants are going to treat the uncertainty. So I've got more hope, and we're going to produce a paper in the next few months on the accounting treatment for reserves. Are there any accountants here? Accountants have been really interested in this subject of unburnable coal and oil, and they've got some great analytics, and I think we've got more chance to get acceptance on accounting standards for the treatment of reserves than we have on a carbon price, and that's where we're putting our focus, on getting the treatment of reserves and reserves replacement handled differently by the accountants, and that for us is a better focus than trying to get governments agreeing on something which is unacceptable.
It's an interesting point. Right here, sir.
Roland Wong with the Natural Resources Defense Council, and one of the groups tasked with the case for making that we can avoid these kind of investments. So my question for you folks are, in a hypothetical sense, if the United States move forward in the immediate term, say in the next 2 years, maybe 4 years, with real actions to extend what we've been doing, which is new standards, enhancing fuel efficiency, enhancing alternatives to oil also. If, say, in the next 2 to 4 years, the United States put into place binding standards, binding programs that could cut, call it 3 million barrels per day of oil by 2030, if there were signals also from other OECD countries that they're moving forward to something similar, maybe call it the equivalent level, what would the impact be on investments? What kind of investments is say 3 to 5 million barrel per day of oil demand taken off the market in 20 years' time sufficient to impact some of these supply investments going in, and which ones are most vulnerable? And is there a certain window, say over the next 2 to 4 years, which are going to be critical to impact a lot of these investments?
Robin, too hypothetical, or is there an answer to that question?
No, I have some thoughts. One is that, I think that policies for efficiency and conservation are great. Forgive me, I'm a dull fellow, but I remember 5 years ago, people from NRDC assuring me with complete confidence that cellulosic ethanol was going to be an important factor in the liquids fuel market. I respectfully submit it's not there yet. So I think mandating some of these things is not a good idea. There's another factor which you didn't mention, and that is, I think that I have a very strong feeling what's going to drive a lot of projects is price. And that's what all this North American stuff, Canada, it's all about price. And that demand is one of the factors in price. But another factor to keep in mind is frankly, going back to the national oil companies and OPEC. And the key question actually is not how much does it cost to produce a barrel of oil in Saudi Arabia. The question is, how much does it cost for the government of Saudi Arabia to operate? There's a big difference. And that OPEC will work very, very hard to try and keep prices above $80. And that is a real driver. And so, and they can do that by cutting back production. And in fact, they have done that in the past when spare capacity got up north of 4 million barrels a day. And spare capacity is quite narrow right now with Iran being down. And yes, if Iraq meets its full potential, but things are going very slowly and very poorly in Iraq right now. So, I think it's healthy to have conservation and more production, but I don't count on dramatic change. I don't know if you agree.
Yeah, I do. I think that you used the phrase happy accident. I think that the happy accident for Canada is that the Saudis want oil at $80 a barrel.
Yeah.
Right, because that means that if they can get past Keystone XL, then pretty much every project they have, leaving aside carbonates and a few things, will probably go forward, and you will get to that kind of doubling of production. Maybe it'll take a little bit longer. It does feel like that's where the marginal barrels can be. So you'd have to see a lot of demand destruction, right? We already have pretty high fuel efficiency standards in this country now. I think a wild card here is what's going to happen in the diesel market. I mean, the administration started to move forward on some different forms of efficiency standards for diesel. There's probably more that could be done there, but it's going to have to happen slowly, given the macroeconomic environment. Speaking of which, on macroeconomic, we also have to remember, and I think this point was made earlier as well, that yes, there's a fuel efficiency story that's taking place in the U.S. right now, and yes, there's a discounting versus other global crudes, but there's also recession or a very weak economy. So if we get back sometime to sort of that above trend GDP growth, we're going to see the gasoline come back to some extent, and the same factors play out globally. So all that leads me to say that I think it's not going to be easy to beat down another 3 million barrels a day of demand. Certainly not in the U.S.
Yeah, Mark, any views on the suggestion mandates and other government policies here work?
No, I'm thinking it slightly differently. I'm thinking in my mind where the real losers here, and we have to say it's the coal industry. From a carbon constrained world, that's clear. Who are the winners? It's going to be gas. You're right, a lot of the oil is going to get developed within our carbon budget scenario. Where we have to look is on the margin is the more tricky and difficult to access oil, and that comes down to price and profit margins. You're absolutely right. My hunch is that the cost of getting this oil out is going to be such that the profit margins are not there to support the investment. Now, the problem we've got is that a lot of money's already gone in to develop projects, and the price has dropped, and they're not economically viable. But they continue to sustain themselves for a while just to see how prices pan out. We've been working with a few rating agencies, I can't mention which ones, to factor in a carbon-constrained world, how does this hit the stock price, and how does this hit the ratings of some of the publicly traded Canadian tar sand companies, and they drop a notch or two. Now, when that happens, the cost of capital, the price to raise the debt on these projects suddenly goes up, and these marginal projects are going to get killed.
Interesting. Other questions from the audience here? Yes, ma'am.
Susan Casey Lefkowitz, also from the Natural Resources Defense Council. Sorry to have two of us in a row. I thought I might get chosen later. But I wanted to raise, sort of come back to the point that Adele made earlier on externalities, but raise it in this context of thinking about the economics and the price and the costs. There are a lot of different, when we look at the entirety of especially these newer forms of oil, it's not just carbon, of course, and water. It's also public health, it's destruction of land, it's air pollution. There are a lot of impacts that they have that right now, essentially, a lot of the oil industry is getting a bit of a free ride. The regulations are relatively weak when it comes to oil extraction, especially in these newer forms where they're having newer and different types of risk than we saw in the more conventional forms of oil extraction. And in a way, it's a type of subsidy to the oil industry. And that's something that needs to be factored in, and it's part of what the carbon tracking is about, trying to factor in also the real cost of carbon, because an even bigger part of this is when we look at the market in the entirety and we think about the kinds of benefits that could be coming economically from the oil industry. The other part of the ledger are the costs that are going to be coming from climate change and from a lot of these other environmental impacts. And these costs are not small. We're starting to see more and more around the world that these are very, very high economic costs. And so I wonder if you can comment a bit, not just looking at it from the lens of the oil market, but thinking about it a bit bigger picture when it comes to the sort of full cost and benefit ledger where things come out.
Rob, do you see a free ride?
I think that this question of internalizing the externalities is a huge problem. But going back to your point, Mark, is that so far there has been no willingness of the consumer to permit this to happen. However you do it. Now, there's a very interesting article, a book by a guy at Oxford about the economics and how everyone's going about it the wrong way, and that what one should be doing is trying to put the price at consumption, not at production, and then frankly let the market work out what's most efficient, and theoretically you could have a better result. I think that if you look at what's happened in Europe, as I say, I mean, if you look at particularly electricity markets in Europe, that is not a model for success, and it's really, I mean, my view is whatever you choose for programs to be environmentally sustainable and scalable, they also have to be economic, however you do it. I don't have the answer. I mean, it's a profound question. But I think at times some of the solutions proposed really aren't economic, and consumers and politicians just won't agree to it.
Mark?
I mean, we took on, I mean, to a degree, the carbon tracker analysis, where we say 2 degrees warming, all the fossil fuels that take you above that, you have to discount them to zero in terms of your valuation. This means that the valuations that support most of the publicly traded coal, oil, and gas are probably going to be out of kilter. For those of you who are interested in this, HSBC produced a report on carbon, fossil fuels, using the carbon tracker analysis. If you want a copy of it, it's a 50-page report. I can email it to you. Just give me your card. They factored in a 2 degrees warming world onto the valuations of the big coal, and the valuations are clearly out of line. They're saying that they will take a 40% hit to the valuation. Now, that's quite significant if you own a portfolio of those companies, taking that kind of hit. And so we started to do the modeling around this. I think it's absolutely essential this is built into the price, but here's the question: how do we make it real to people who are making investment management decisions? And there is a challenge. We have those that use Bloomberg terminals to make your investment decisions to get your data. You can go onto Bloomberg Industries, you can pull out what you call ESG, environmental, social governance information, and you can start to pick up shadow pricing that factor in some of this information. Now, the challenge that investors have, it doesn't sit on the main part of the terminal, it sits on a special piece of the Bloomberg terminal, and it's only really picked up by a very small minority of investors. once this data can be picked up by all portfolio managers, they can start to adjust their investment decisions. Where we'd like to be is to put shadow prices, real prices, on the large publicly traded oil, coal, and gas companies to reflect a 2 degrees world. They're going to take a hit. We just haven't done that work yet. We'd love to start doing that work because we think that there can be some really interesting work done. Now, the asset owners, you're absolutely right, your point. The asset owners are picking up on this, and they're concerned that they're sitting on mispriced assets. And we're starting to do what we call value at risk analysis. How big a risk do these companies take if they can't develop the reserves that they've essentially taken money off investors to develop? And this is very significant. And as this, what we call a carbon bubble, deflates, what's going to be the impact on the banking system? And so we've been doing some work that's going to be looking at that.
Interesting. Other questions from the audience here? Dan, in the back. Oops, maybe we should toss the microphone.
I'm Dan Becker from the Safe Climate Campaign. Let me try again on profitability. How is it that heavy oil, companies developing heavy oil will make money? And how will that be affected by water issues, by export and Jones Act type issues? And what other major factors will determine whether these are profitable or unprofitable efforts?
Yeah, just price. I'm not being cute. I mean, these projects, if the price is at a certain level, which you can get a return on your investment, but then there may be deep discounts if these products or the commodities can't get to market. I mean, this is all going to be driven by price. And now, how you influence the price, my view is that I've always believed that there's going to be a lot of this whole question of infrastructure in the United States and permitting pipelines and Jones Act and all this kind of thing. I mean, I think there are people who are going to try and use those regulations to drive up price to try and stop activity. But to me, correct me if I'm wrong, but I think it's...
No, I agree, and I think that's, with Keystone XL, I think that, if Keystone XL is turned down, then Enbridge will expand their pipeline, you'll get the same volumes pretty much down to the same place. I agree totally with Robin that it's price-driven, and I think with oil sands, we have to differentiate between prospective investment. Yeah, I mean, conditions right now are no one's greenlighting these projects when they're looking at a realized price for Alberta heavy at somewhere around $50, right? It's just not going to work. It's too low, right? However, if you're Suncor or Syncrude and you have an existing mine that you built 10, 15 years ago, you're fine all the way down to $35 to $40 a barrel, right? In part, that number's gotten better because the natural gas input cost has gone down dramatically, right? That's a huge swing and a win for these gas-intensive oil sands producers up there. But that's really what's going to come down to is price. And carbon could, play a role there. Alberta's put almost like a placeholder carbon price in place. It's not really influencing the direction of investment now. But if consumers and voters demanded it, Alberta would, or shareholders maybe, you could see that price go up, and that might start to impact projects as well. But we're not anywhere near there yet.
But also, some oil companies are, in their long-term plan, are factoring a price for carbon in it.
Right.
They, frankly, would much rather deal with a carbon price than they would, frankly, some other very kind of random, unpredictable measures.
Mm-hmm. Jessica.
Thanks. I'm still searching for the bottom line in this, forgive the phrase, in this discussion on price. Markets, there is no regulatory system in history that is either wise enough or agile enough, I think, clearly to deal with this situation. At least I can't imagine one, and certainly not ours. So that leaves you with the market, and the inclination is to say, put a price on carbon, turn the markets free. But markets have two other problems. One is the one you've just pointed out, Mark, that the oil market is not a free market. OPEC is sitting there with the capacity to shape it. And secondly, markets also get highly irrational, right? They produce bubbles. They're driven, they are often less wise than we'd like to think they are. So is the bottom line of this discussion of these two panels so far that a carbon price, at least, notwithstanding these two huge drawbacks of the markets, is it at least strong enough to differentiate by carbon intensity among these 160 different kinds of unconventional oils? Or is this too going to turn out to be a disappointment? I'm assuming we could get it.
Let's, you know,
That's where I was gonna go, yeah. I think that the kind of carbon price regime we're likely to get in the next 4 years at least would be so constrained by political reality in terms of having safety valves and free allocation of credits and so forth that it really wouldn't impact in a material way. It might at the margin, the overall direction of investment in these unconventional oils relative to the larger price story. I mean, if the politics change and we get a more aggressive carbon price regime that was really truly more market driven and had a UK style carbon price floor, which is a new thing. I mean, there's things that could change that, but it doesn't seem likely, even though that might be the right model, the kind of system we get politically, at least from the perspective of oil investments, I don't think would have a big impact in the short term.
can I offer another thought here too? And that is that if there are sort of two pitches that I had here, one was price and let markets work, but also let people innovate in markets. And that's what happened in North America. And there's an innovation, for example, which people haven't paid much attention to. One of the questions is the economics of wind. And wind is either free, very low cost, or it doesn't blow. I mean, it's this question of interruptibility. Well, General Electric is now, Jack, you were at the session in Aspen. It was very interesting that General Electric is now developing turbines that can kick in very quickly when the wind dies, and it's starting to change and combine the economics of gas and wind. It's very effective. I mean, and there are things out there. I mean, one of the things, I'm sorry, I was in government, but I am deeply suspicious of government's ability to mandate wisely. I'm sorry, I don't think hydrogen was a great idea. I don't think cellulosic ethanol is a great idea. I don't think a lot of these things are great. I just don't think they're scalable and commercial. But I think that to the extent you can encourage markets, do basic research, do a number of things to try and find, because if there's solutions, I'll bet they aren't mandated by bureaucrats.
Did you answer my question though about, given OPEC's pricing power?
Right.
Is it, how high a carbon price would you have to keep it from being swamped by OPEC's ability to impose a price, so that you could still get some differentiation by carbon intensity among
I think that implies a mechanism between OPEC, which is really the Saudis, and I'm not quite sure who'd be on the other side for these discussions. In a perfect world, you could do that. I mean, quite frankly, some of the most advanced environmental research in the world is being done in the Middle East right now, and the application of solar particularly. I mean, one of the problems the Saudis have is they're using enormous amounts of fuel oil to generate electricity and to meet their growing economic demands and their population problems, and they can't export this crude to China and generate foreign exchange. And so one of the big solutions for them is solar. So, I mean, again, there will be some very unpredictable outcomes in all of this. I personally think that the most efficient way is find a way, obviously, to price carbon, but it's got to be meaningful. And I don't know where you're going to find the political will to do it.
Yeah.
Well, Mark, do you see any sort of way, I know you don't think a carbon price is likely anytime soon, but do you see any way of establishing one that would meet the kind of uncertainty that Jessica is suggesting?
I think as I mentioned it before, I mean, I'd love to have a carbon price that was implemented that would work. You're right, it's being factored into certain analyst models, a carbon price, but you're also right, there's no political will for it. But my question is are we searching for this as a tool where we can get to the same ends by using different devices?
But
Well,
the
so-
device you're saying, I mean, it's a sense, if you want to stop the Canadian tar sands development, which I would think would be on your agenda to stop, then stop Keystone XL. It's to create other barriers which drive up price and hence make those things unproducible, uneconomic.
Then you
and
also have to stop
we have
rail
to-
and
we
other
have to have
pipelines.
we have to have a mechanism that applies not just in the US but globally. And if you
Good
look
luck
at,
on that one.
Well, I tell you where we have a common set of standards, and we're getting this. We have something called international accounting standards, and what we're seeing is that global harmonization far faster than the politicians imagine, because the accountants are just getting on with it.
Again, you're seeing the road through simple accounting.
It as one potential tool. Is essentially we're spending one company like ExxonMobil will spend $10-20 billion a year on reserves replacement. Now, if they can't book the reserves, they can't state those reserves because if in their entirety they can't be burned, and the accountants are saying we're going to qualify the accounts and you can't book them, that would disincentivize.
Just remember those accountants get paid by Exxon.
Well,
Well,
let's
this is the other issue.
let's try to get a
Big
couple.
one.
We got time for probably a couple more questions. Jack, you had one right here.
I wonder if you aren't really more in agreement than it sounds. It seems to me that neither a carbon tax a carbon tax could work alone, but it seems to me your disinvestment strategy would require a carbon tax or something like it to be in place to have the investors really believe that in fact they're going to lose money on all those reserves they've got in the ground. Don't they work together? I don't think the students asking the colleges to disinvest is going to do it.
No, if you look at Bill McKibben's numbers, if you read the Rolling Stone magazine, all his numbers are based on our report. We didn't come out calling for divestment. If you hit carbontracker.org and see our list of asks, the first thing we ask is for companies that own reserves have to translate them to CO2 and then add that number up and tell us beyond which we've broken the budget. And then for a regulator to come along and say, what does this mean for financial stability? That's what our asks are, not divestment. I want to be really clear about that. I don't think getting student colleges right now, it's kind of good to get people thinking about it. It doesn't get us where we need to be. What I'm puzzled by is knowing that we can't develop these reserves, why is it that most of the IPOs coming through are to develop new oil and coal and gas resources? It's because it's fantastically profitable, kicks off a load of cash, every investor wants to have it, but logically it doesn't make sense. And that is the dichotomy which we struggle with and we have to resolve when it comes to policy.
Logically, it doesn't make sense, or it may not make sense in the future. There's an important difference.
I think if we to say the next 10 to 20 years are the time when we make the decisions about whether we want to stay to 2 degrees, in my view, 10, 20 years, it doesn't make sense. Now, you're right, we could leave ourselves another 30 to look back and say, did we get that decision wrong? I just don't want to take that risk.
I still don't understand who's going to make the decision.
You're right, there's no one investor. Investors work together in many ways. Now, when it comes to that decision, let's look at where investors make decisions collectively. As you all know, there's 70 to 80% of publicly traded stocks are explicitly or closet index trackers. They buy everything on the index. So as soon as there's a new coal IPO, everyone buys it, even if it doesn't make sense. We have to question how that mechanism works and whether it produces the right outcomes for climate policy. Clearly it doesn't. We're still exploring what we need to do.
Well, I think that's all of the time we have. We've had an interesting panel discussion here with Robin West from PFC Energy, Mark Campanelli from Carbon Tracker, and Robert Johnston from the Eurasia Group. Let's give them a hand for their insight and all.